Good morning, everyone, and welcome to the webinar presented by Kreston South Africa on managing business disruptions. And as usual, we'll look, we'll take a tax, accounting, and technology perspective on managing business disruptions. Just the contents of the webinar. I'll do a quick introduction, and then we'll hand over to Motala that will look at the accounting and financial implications of business disruptions. Phillip Kaliati will look at data security and cybercrime, and then Johan Heydenrych will look at the tax impacts of business disruptions. So as you know, I'm Jacques de Villiers, the Managing Director of Kreston South Africa. Now, just as an introduction, if we look at risk registers and disaster management plans pre-January 2020, it looked vastly different to what it should look like now. You know, in March 2020, COVID-19 appeared, and the whole country was in lockdown, and that had major business disruption as a consequence. More recently, in July 2021, we had political unrest and riots, and that also crippled the country and devastated some of the businesses. So risk committees and risk registers definitely should be altered based on only these two events. Now, we were quite involved with a number of companies, and I can tell you that not one of those companies had something remotely to COVID-19 or a similar virus identified as a risk. And you know what the influence of COVID-19 was on all businesses. It had major impact on most businesses. We experienced lockdowns, curfews, and other trading restrictions. Now, when we're talking about business disruptions, we now think of big disasters like COVID-19, etc. But the reality is that it can also be smaller incidents, like a divorce or a death of a business owner that can be devastating to the survival of a business. So those plans and business disruptions should definitely be altered on a continuous basis. Now, Kreston South Africa has assisted cyber to develop a guide for small and medium and micro enterprises specifically for business disruptions. Please download that from the cyber website. It's quite a handy tool to look at. I'm quickly going to look at the extracts from that cyber guide. And as with any plan for disaster management specifically, planning is the most important step or aspect for any plan to prepare for things when things go south and when it does happen. So on this planning stage, the guide actually gives you quite good templates. This is a planning template that we refer to. Now, if you just orientate yourself with a slide, there's a description of the risk where you describe the exact risk which you want to mitigate and which you want to attend to. The second column is the likelihood of this risk occurring. You know, is there a high, moderate, or low likelihood of this risk occurring? Then the next part is the impact on stakeholders, the employees. What impact will it have on them? Customers, fixed property, stock, debtors, and your other assets, and then very importantly, business continuity. So if you want to address those risks that has a likelihood, a high and moderate likelihood of occurring, and also a high and moderate impact on stakeholders. You have to prioritize based on the likelihood and the impact on stakeholders. So if we look at the risks, firstly, you get uncontrollable risks. These are more your external risks, those that you can't influence and that will happen despite your best efforts. So these are risks that the SMME owner has little or no control over. Now, this includes like global and national health disasters, drought, floods, riots, looting, political unrest, etc. Collapse of governments and government instability. And if you're working in Africa, this is definitely one of the highest risks that you will face. There's also inflation and other economical risks, and also collapse of infrastructure, load shedding, electricity, the unavailability of the water supply. So that's your uncontrollable risks. You will also have your controllable risks, and that's more your internal risks, the risks that the SMME owner has control over. So this relates more to death and disability of the business owner, conflict between business owners, reliancy and dependency on key personnel, the availability of infrastructure as well as resources and supplies, etc., the non-compliance with laws and regulations, etc. I'm not going to go through everyone. But technology risk is also included here, cybercrime and the loss of data, etc. As part of the planning phase, you will now move on to the action plan template. In this template, you will describe your risk, exactly what the risk is that you want to mitigate. Then you have to look at the action plan, detail your action plan, and give a detailed description of what your action plan will be to mitigate this risk. This will become your disaster management plan for the business. On completion of the plan, this document will be communicated and shared with the responsible parties and filed and listed with the company's document. It has to be easily accessible. You will also estimate the cost to implement this, the time that it takes to implement it. You will also rate your efficiency and effectiveness of this plan. Once we've identified the risks, we will move on to the action plan template. Here we will describe the risks that we want to address. Those are the moderate to high likelihood and the moderate to high impact. In this risk, we will describe it. We will also do a detailed action plan of how we're going to mitigate this risk. This will become the official disaster management plan of a business. On completion of this, we will communicate this to the responsible parties. We will file and list it in the company's document register, and it should be easily accessible. We will also estimate the cost to implement it, the time to implement it, and we will estimate the efficiency and the effectiveness of this plan. We will also assign a responsible person that needs to take responsibility for this plan. It's a jockey that will look at this. If we go back to the stages of the disaster planning, we've looked at the planning phase now. The next stage is early warning. That means that the business owner and management has to keep their ears close to the ground. They have to know what is going on. That means they have to be aware of what's in the news. They have to have constant discussions with industry, market leaders, and also trade unions. If they know what's happening, they will be able to address and be prepared for any disaster that is coming. Dealing with the event is very important, and the cyber highlights 6 important steps in dealing with the event. But if you go through it, you will see it focuses on how leadership reacts to that. Then once the event occurs, how do we recover in the aftermath? The cyber guy deals with especially financial, physical, and emotional recovery. You will realize that any disaster has an emotional side as well. And even if you look at COVID-19, can you remember the fear that gripped the country, that gripped employees? They didn't want to go to work, etc. And that's how you have to recover in the aftermath and getting the business back on track and making sure that the business can survive. Now, any crisis is a good learning opportunity. One learns more from when it is tough going than when things are smooth sailing. Adapt and improve processes and procedures and make sure that the business is adequately prepared for when the next disaster happens. Learn from your mistakes. We're going to go now to Motala. I'm quickly going to introduce him. He is the managing partner of Kreston KZN, and he will look at the financial reporting and compliance with Companies Act. Welcome, Mahommed. It appears that the accounting and financial statement disclosure aspects become very relevant and critically important in these times of upheaval and trading and business uncertainty. I think to keep all your stakeholders abreast of the situation and the impact of the company. But are there areas that require more careful focus and attention by especially directors and management? And what is the impact of not complying?
Yes, Jacques, thanks very much, and welcome to the panelists and to the listeners out there. But definitely so. I think especially against the backdrop of COVID-19 and the looting and civil unrest that has occurred in July 2021. So I think if we go to the snapshot slide, so yes, Jacques, during times of financial stress, I think it's obvious that fair presentation is at greater risk of being compromised, due mainly to management's inadequate assessments of the ability of the company to continue as a going concern, deliberate non-disclosure, deliberate misinformation, and oftentimes improper accounting due to nefarious purposes and through ignorance as well. So I think if some or all of the above do occur and can be proven, effectively would result in the breach of various sections of the Companies Act, but more especially so Section 77, which is the breach of fiduciary duties of directors and officers, Section 22(1), which relates to a prohibition of companies to trade recklessly. And all of that would then amount to, in effect, fraud, misrepresentation, misinformation, gross negligence, which with that having been proven then, directors' officers can then be held personally liable for loss, damages, cost to the company itself and to others that may incur loss due to those actions. So I think it becomes very, very important that this aspect is given more care and more attention in ensuring that fair presentation is achieved. So I think there is a very intricate relationship between fair presentation, the going concern assumption, financial statement reporting, and personal liability. So I think we will have a brief look at some of the aspects of the going concern assumption and fair presentation, and then we will take a look at some areas that could be impacted in terms of your balance sheet assets and liability. In these times, it becomes especially more relevant that companies' management perform a holistic review of the aspects that would impact on the ability of an entity to continue as a going concern. And against the backdrop of COVID-19 and the rioting and looting that we have just come through, historical information that was previously used would not always be relevant anymore. So in undertaking this would provide you with a snapshot of what would need to happen, that you need to assess all information that exists and available to you as at the year end of the company, all information subsequent to year end, up to and including the date of approval or publishing of those financial statements. I think importantly then it's got to account for current and the future impact, current being in this context up to the date of the approval or publishing of financial statements, and future impact would relate to looking into the foreseeable future. So it is a fairly comprehensive review that is required. And importantly so, it's no longer relevant to focus merely on your business itself. In terms of the various problems that have arisen, industry issues have certainly had huge impact on business and trading. And all of those assessments need to be brought into account. And we'll take a look at some of those issues as we move along. If all of that is done with due diligence and due care, that should result in full and proper accounting and disclosure and effectively fair presentation. And ultimately then, I think having achieved that, directors do then have some protection against being held personally liable for misrepresentation. Like to mention that in the South African context, and generally in the non-government sector, the two recognized accounting frameworks that are most often used are the International Financial Reporting Standards and the IFRS for small and medium-sized entities. And both of them have embedded in them fair presentation as a requirement. In addition to that, fair presentation is a statutory requirement for a vast number of the financial statements that have to be prepared in terms of the Companies Act, especially for companies with a public interest score of more than 350 points. So in any event, in other entities that are not governed by the Companies Act, the true and accurate presentation of the affairs of companies nonetheless a requirement, as these would be covered by common law in terms of directors' fiduciary responsibilities. So there's not too much room from getting away with completely and fully disclosing the impact of the recent issues on your business and undertaking. So I think it's an inherent assumption in financial statements that the business is a going concern unless management has decided or intends to liquidate, to cease trading, or it has no alternative but to do so. And bear in mind that these assessments with those factors in mind are conducted up until the date of the publishing of financial statements and not necessarily just at the year end. I think moving on to the next slide then would be that if in that process you've identified material uncertainties that relate to events or conditions that cast significant doubt about the entity's ability to continue as a going concern, then those uncertainties have to be disclosed and fully disclosed in the financial statement, especially as they relate to close call judgments and assumptions. And close call judgments and assumptions would be situations where there are significant uncertainties, but management does have an action plan and it can motivate and mitigate against the risks of those uncertainties. Then those close call judgments and assumptions need to be fully disclosed and discussed in your financial statements. And it's obvious then that entities that cannot prepare financials on the going concern basis need to state that very clearly, need to state the basis on which they've been prepared and the fact that, and the reasons as to why it's not a going concern. So I think it's especially relevant now that historical information is not the only factor that needs to go into these assessments with regard to business and the future that they're moving on into. They will be required, but no longer the only data required in assessing the impact of the disruptive events. I think we have mentioned that in this assessment you need to look at your business and in industry effects. I think the industry issues are fairly obvious, where you'd be looking at your cash flows, your suppliers, your customer base, your human resources, and the impact that could have occurred there due to COVID-19 or people that might have been injured, etc. From an industry point of view, there could be various factors, but importantly now could be government rules and regulations. It could be related to import tariffs. Certain industries could have minimum wages that have been implemented. Lots of industry now, in terms of the remote working environment, would have significant technology advancements. You'd also need to look at the competitors that you're dealing with and the advancement that they have made under the difficult circumstances, and threats of substitute products, especially through imports. As mentioned, when we're analyzing the immediate and future impact, the future impact relates to the foreseeable future. So it's quite an intensive look down the path as to what you foresee the company is going to go through. I think you've also mentioned already that all relevant factors at year-end and subsequent to year-end would need to be taken into account, and some of those would need to be disclosed and some of those would need to be adjusted depending on the circumstances up until the date of publishing of those accounts. think when looking at the 360-degree view of the company itself, some of the areas that you would be especially interested in would be that can you retain your market and sustain your market base and customers to be able to generate adequate turnover. You might have lost stores, there might have been product lines affected, you might have had damages to your premises. So in that respect, that assessment becomes more important. We need to also bear in mind that can the business remain profitable in the light of constraints in access to raw materials and supply chain management problems. Access to credit facilities could become a problem going forward, especially in the light of poor financial results. And if you already breach certain loan covenants, then those could be restricted further. Projected cash flows and impact on liquidity, the survival in the face of unfavorable media attention. So these, together with a whole host of other aspects, need to be taken into account. And if that's done again with good faith, diligently, should provide evidence that management has given consideration to the going concern assumption and that it is not trading recklessly. I think the analysis of the event itself in this case is fairly straightforward as compared to when COVID-19 hit the shores. So I think the looting and rioting occurred in early July 2021. So financial statements of the 30th of July or prior year ends, that event would qualify as a non-adjusting event with full disclosure on the current and future impact on the business and operations and the ability of the company to continue as a great concern. So for entities with the 31st of July or later year ends, I think the event has already occurred. So as opposed to a post-balance sheet event, the actual assets and liabilities on books would need to be adjusted to reflect the actual impact of those balances at year end, taking into account subsequent events that may shed better light on what those balances should really have been at year end. I think there's three scenarios which effectively summarize the situation. So one is the going concern assumption is valid. Fair presentation then is much easier to achieve. If it's not valid, you cannot use the going concern basis accounting. You've got to disclose that the basis that you have used in preparing those accounts, the reasons, and provide adequate disclosure. And as mentioned, if there's material uncertainties or a close call circumstance, it is possible, not always so, but often possible that you can continue to use the going concern basis, but with extended disclosure of the uncertainties, judgments, and assumptions linked to the cause call, and a thorough analysis of the current and future impact of the various factors on the company itself. Some of the material balances on the financial statement that could be in fact impacted. Lots of these would have been impacted due to COVID-19 itself, but especially so, this discussion focuses on financial statements to be prepared after the 31st of July onwards. And I think keeping in mind the impact of the looting, rioting, and unrest that it could have on these balances. I have provided a reasonable list of items that you would need to look at. It's by no means comprehensive or exhaustive, but certainly some food for thought. Some of these areas are very technical, so a lot more research on your side may need to go into them. I think of importance and of huge impact would be the impact on the fair value of investment properties, since both the SMEs and the full IFRS standards requires that this reflects market perception and market data, which can be very subjective. So generally, we in this time be expecting a decline in the fair value of investment properties due to unfavorable changes in the input data. And the relevant input data that would be changed and different, most likely to the historical context, would be deteriorating tenant financial positions, the general economic downturn, increase in vacancy factors, cost of security and cleaning would have increased significantly. In shopping centers, foot traffic would have decreased, physical deterioration of the properties due to the rioting, unrest that might have occurred. Perceptions of crime in the area would have changed. So taking some or all of these factors into account, would have an effect on market perceptions, which effectively puts pressure on your capitalization rate. And I think we're already seeing that in the calculations, especially in the discounted cash flow models and the earnings capitalization method, that capitalization rates are now slowly creeping up, which in effect would decrease the fair value of your properties. I think the other big area to keep in mind would be the impact on trade and other receivables. We expect to see actual bad debts as customers shut shop post-looting and rioting to increase significantly. Impairment of doubtful debts under SMEs and your expected credit loss provisions in terms of IFRS 9 standards would certainly go up as cash flows would be extremely constrained across the board. Bear in mind that your estimated credit loss under IFRS 9 has to factor in past, present, and future expected conditions and outcomes based on unbiased probability weightings. And I think with the bleak economic outlook and cash flow problems that are forecasted, these are certainly going to increase radically. I think another huge area that may not get a lot of focus or might be neglected is the inventory side, but more so the standard costing and product costing side of things. So in manufacturing concerns, we'd expect going forward that there need to be adjustments to the standard costing models. Input costs of raw materials, direct overheads, labor costs will be skyrocketing as we go forward. And that would need to be factored into the closing stock due to the changes in standard costing models. Becomes especially relevant now with the impact of some of the manufacturing plants that might have been closed down for repairs or for revamp or for replacement of machinery equipment, that they may have been extremely and abnormally low production volumes. And in such circumstances, the unallocated or fixed overheads cannot be allocated the cost of inventory, and these have to be taken to profit and loss, being due to excess capacity. So that would have an impact on your profit and loss statements to a large extent in manufacturing companies. We'd also expect to see greater provisions for stock impairments due to damages and spoilages during the rioting and unrest process, but also I think that happened during the peak winter periods. So many businesses in the fashion game and some in the food game who stock up for winter wear items might have missed that critical period. So this stock will now have to be held over into the new year and probably be sold at significant markdowns. So we'd expect to see a great pressure on the stock impairment provision being brought to account. I think another very topical area right now would be insurance recoveries and the estimation process. Normally quite a straightforward process, but with the pushback from insurance companies in trying to minimize the impact of claims against them, these have now become fairly complex and uncertain. So if you are going to bring those into account, you need to obviously have a valid insurance policy in place. You need to be able to demonstrate that you have a right to receive those payouts, that the payout is reasonably certain, and that you can, within reason, estimate the amount, and then you would need to disclose any assumptions that might have had to be undertaken in arriving at that estimate. Again, very topical and relevant right now would be lots of companies, or not lots, but companies in certain industries would be eligible for government grants or grants from NGOs. I think very important to realize that you cannot blindly bring those into account. You have to have had a valid application. You need to have meet the criteria to qualify for those grants and fundings. You need to be able to demonstrate that you can comply with the conditions set down to utilize those grants. You need to have a right to receive the grant, and the receipt must be reasonably certain. So that could have a reasonable impact on financial statements if you do qualify for those. Another important area, and sometimes overlooked, would be that of onerous contracts. And in effect, those are loss-making contracts. These could apply to long leases, could apply to contracts to deliver goods or services. And in effect, what that means is that an unavoidable cost to fulfill those contracts then far outweigh the economic benefits to be derived out of those contracts. So this is one of the few cases in IFRS where future losses, in effect, would have to be written off and provided for at year end. And that normally has to be done at the lower of the expected loss to comply with that contract, or the penalty that would need to be incurred to extricate from that contract. I think one of the other important areas that would very likely affect some businesses would be the breach of loan covenants. Debt equity ratios might fall through the cracks, interest cover might not have been achieved. In that situation, it becomes especially important to disclose those breaches, status of the negotiations, likelihood of success of those negotiations, and any uncertainties relating to successful renegotiations. I can keep in mind that in extreme cases where the banks are not, finances are not wanting to negotiate, those debts may become repayable on demand and therefore have to be reclassified from long-term liabilities to current liabilities.
What then is the consequence of non-compliance with proper financial statement assessments and disclosure for directors, officers, and management of a company? And can they be held liable? You know, are there very specific Companies Act legislation that impacts on directors' liabilities in such situations?
Yes, Jacques. I think there's very serious consequences that will result in personal liability. And there are numerous provisions in the Companies Act as well as in common law that deals with this issue. So I think one of the fundamental issues in the Companies Act to be borne in mind is Section 22(1), which prohibits reckless trading. So a company does not carry on its business recklessly, with gross negligence, or would intend to defraud any person or for any fraudulent purpose. I think it's important to keep in mind that this section defines a director to include a prescribed officer, a board member, or the committee member, and in effect would include any senior person involved in decisions relating to aspects that could result in reckless trading. I think a very quick overview would be that in terms of common law, directors were always held liable for breach of fiduciary duty, and the 2008 Companies Act attempted to partially codify some of those common law into the Companies Act to ensure that the directors and officers can be held more easily liable for the breaches of fiduciary duty. I think a few of the fundamental provisions that need to be borne in mind is Section 22(1), which prohibits reckless trading, Section 77(2)(a), which holds directors liable for breach of fiduciary duty, Section 214 and Section 218, criminal liability for fraud, misinformation, and falsification, and importantly, Section 218 brings in civil claims, opens the door to civil claims by the company itself and any other person against the director. And I think we'll have a quick look a little later on in terms of Section 216, what are the fines and penalties that are imposed in the case of breaches of these sections of the Act by directors or officers. I think we've looked at Section 22(1), but underpinning a lot of the provisions of the Companies Act is Section 4(1), being the solvency and liquidity test. The old Companies Act focused a lot on capital maintenance, and there was a shift in the 2008 Act into solvency and liquidity, which primarily requires that your assets fairly valued exceed your liabilities fairly valued, and company must be able to repay its debts as and when they become due and payable in the ordinary course of business. I think in the context of solvency, liquidity, and prohibition of reckless trading, Section 76 becomes very relevant in that it establishes the standards for directors and officers. And in summary, it's quite a lengthy provision, but in summary, it holds directors responsible for breach of directors' responsibilities and duties. It requires them to be transparent in their conduct and in effect also prohibits use of inside information to gain advantage for their personal selves or to cause harm to others. If we move on to the next slide then, Section 77(2)(a) would hold a director liable in common law relating to breach of fiduciary duty for any loss, damage, or costs incurred by the company, and in terms of the sections 3b, for any direct or indirect loss sustained by the company. It's important to bear in mind that directors cannot be relieved of this liability. They cannot contract out of it. No provision in the MOI or any agreement between the company and the director itself, or no insurance policy can contract them out of these liabilities that emanate by virtue of the Companies Act itself. If we then move on then to the next slide, and very briefly so, a few important provisions here that Section 214 effectively places criminal liabilities for acts of fraud, misinformation, fabrication of records against companies or creditors or employees. So effectively covers most individuals who would be dealing with a company. Section 2144 basically states that you are guilty of an offense if you have breached these provisions, and you are then personally liable to the company and to any other person. 2183 then, in effect, opens the door for civil claims. And not only are you liable to the company itself as a director or officer, but to any other person that might have sustained losses. Penalties are quite severe, as you can see, that if it's related to breach of fiduciary duties, fraud, misinformation, then that can be a fine and or maximum 10 years imprisonment. And for lesser offenses, then it's a fine or penalty not exceeding 12 months. I think very important to bear in mind that representative taxpayers, in terms of the Tax Administration Act, Chapter 10 and 11, that you can be held liable for monies that you've dispersed or paid out after a tax liability arose in the company itself. There are a few transactions I've thought of just discussing that would require some very careful introspection in the current situation. So I think the first and very important that the act of preparing financial or going concern basis when there's clearly no prospect for the entity to continue the going concern would in effect be interpreted as an intent to defraud creditors, suppliers, etc., and the breach of Section 22(1) reckless trading. Preparing financial statements on a going concern basis, but not disclosing the significant material uncertainty surrounding that would also be a breach of fiduciary duty and open up the doors of personal liability. So in the current context, I think if a director allows goods to be received or services received by his company on credit, knowing full well that they will not be able to pay for these, then you've again opened yourself up to personal claim due to reckless trading and intent to defraud creditors. Section 45 becomes very relevant in terms of providing financial assistance to directors. Many smaller companies where the shareholders and directors are the same, they may authorize payments to themselves in terms of paying off of loans or to related companies without much formality or lack thereof, and these could result in personal liability, and these are subject to the solvency and liquidity test primarily as well. Dividend distributions, very relevant at this time, where we've seen listed companies having reverse decisions where they have proposed dividends, and essentially to stay within the provisions of the Act. So a director could be held liable. He was present at a meeting to make a decision to approve a dividend that was contrary to satisfying the solvency and liquidity test. And I think also very pertinent now, where directors, shareholders might make decisions to strip assets out of a company before it goes into liquidation. Clearly, that would be deemed to be an intent to defraud creditors and outside party. So all in all, I think there are a number of areas that need to be focused on, and I think the time permitted, I think we have considered some of these. Yes, Jacques, I think that should summarize my side of things.
Thank you, Mahommed. Thanks for your contribution there. I'll move over to data security and cybercrime, and Phillip Kaliati, who's a senior consulting manager at Kreston, Pretoria, will have a look at it for us. But I just want to draw your attention to the Institute of Security Studies discussed the implications of the July 2021 cyber attack on Portnet. And it reported that, and I quote, the disruption primarily affected operations in several container terminals, interrupting cargo movement. 4 days later, Transnet confirmed it had suffered a cyber attack. This attack is unprecedented. Since the start of COVID-19 pandemic, the number of cyber attacks has been increasing worldwide, and in South Africa, inflicting financial losses across the manufacturing, banking, and energy sectors. South Africa's critical infrastructure has been targeted before with minor impact. The recent incidents was the first time that the operational integrity of the country's critical maritime infrastructure has suffered a severe disruption, end of quote. So Phillip, can you provide us with more information on what is cybersecurity, how you can maintain it, and what you should do if you are a victim of a cyber attack?
Thanks, Jacques. So in terms of what cybersecurity is, we would have to, or I should say, I would want to reach out to this model here called the CIA triad. And of course, we're not referring to the intelligence agency in this context. So what CIA stands for is confidentiality and availability and integrity. So this relates to your systems and your applications and your data. So if there's any risk to the confidentiality of your data and your systems, or availability or integrity, then you are dealing with a question of data security. So I do find this to be quite a useful model because it does capture quite a lot of issues, and there's a lot that's packed into those 3 letters in that acronym. And I should apologize for the background noise. There's a truck driving past, so I hope it's not affecting the recording. In any case, when you speak of cybercrime, when you speak of cybercrime in particular, then what we're really referring to is any crime that involves computers or that's directed at computers or computer systems and networks and that kind of thing. So going back to the CIA triad, in many cases, when we speak of cybercrime, we are speaking of actions that would quite likely affect or violate one of those principles of data security. So the nature of cybercrime that's prevalent has changed over the years due to a number of factors. I think one of the bigger ones would be the incentives are just different. So, for example, computer viruses have existed for as long as, I believe, maybe the early 1970s. But before, viruses used to be more a research curiosity, right? How do you develop a program that can replicate itself? And you would find viruses, but mostly in essentially lab settings. And after a while, you started seeing viruses out in the wild, meaning in computer systems that aren't in a controlled environment. But even then, it used to be quite lighthearted in comparison to what we have now, right? So you might have a virus that just randomly displays a poem on your computer or something like that. Fast forward to the present day, then you have cyber warfare, you have ransomware attacks, you have financial incentives tied to cybercrime. So all of a sudden, instead of just having a virus that randomly sends, I don't know, images to your printer every once in a while, you have a virus that can take out, or you have malware that can take out that can take out a uranium processing facility and inflict damage in the real world. So there's been a definite change of incentives. Some of them tied to financial incentives. So it is easier to make money off of cybercrime than it might have been in the past. It's easier to receive payments anonymously. So that enables things like ransomware, where someone encrypts all of your files and prevents you from accessing them, and the only way you can regain access is to pay the person who compromised the systems and hope that they will release them and you'll regain access. So greater financial incentives, geopolitics is playing a role now, and the computers are being weaponized. We saw examples of that in, say, in Iran, in the example I alluded to earlier on. I think a few years ago in Ukraine, the power grid was taken offline as well in the course of the conflict with their neighbors. So changes in incentives, and there are more technologies now that have kind of expanded their tech vectors through which a malicious player can reach and cause harm in your environment. So in 1990, the World Wide Web didn't really exist. Like, yes, the internet did, but we didn't have websites as we understand them today. And today we have a very, very well-developed web. We have cloud infrastructure. We have computers everywhere. Right now, you're all viewing this through computers. You probably have another computer in your phone, in your pocket. In other words, your phone. So it's a very different environment to, say, 1943, where it's quite an amusing quote, but I believe it was the president of IBM that said, quote, "I think there's a market size for maybe, there's a world market size for maybe 5 computers," unquote. So we are living in a very different environment. So with those changes in the technologies and how those technologies are used, come changes in the types of threat we face, and with that come changes in how we respond to those threats or position ourselves, such as we prevent as many of those threats from manifesting as we can. So my talk today will center quite a lot on the role of people in combating cybercrime. And this would be through administrative countermeasures. You can have technical countermeasures as well. That's the sort of thing that the IT department will worry about. But it doesn't matter how strong you are technically. If there's a weak link in the form of a human being, then all of that work might all be for nothing. So we have spoken of cybercrime, but there are other threats to the security of your systems and applications as data beyond cybercrime. And this is important because hacking and that kind of thing is very dramatic in nature, and it's fun to talk about, and it's quite shocking when it happens. So when people think of data security, you are, in most cases, or I should say most people would reach out to malicious actors as kind of like the big thing to worry about when you're thinking of data security. But there is more beyond malicious or criminal acts that can be a threat to your data security. So I have listed a couple of issues that could threaten your security here. And this is not an exhaustive list, but it does demonstrate that there are some pretty mundane events that can cause severe disruption in your environment. Everything from outdated policies to civil unrest to flooding. I didn't list pandemic there because I think we've heard about COVID enough. But certainly we did experience that, I think, at the global scale as well last year, and it's still ongoing. We had a recent event in our environment where a lightning strike affected some of our networking hardware. So these threats can come from any direction. And your approach to data security has to account for the reality that there is more to security than just threats to confidentiality, or more to security than threats arising from criminal or malicious actors. So yeah, like I mentioned, like people are quite important today in maintaining security. And part of the reason is because of so many computers, and we all have access to computer systems and must use computer systems in order to carry out our work on a day-to-day basis. So you don't need special access to a very restricted pool of potential targets. These days, pretty much everything is a target, even something as mundane as an internet connected video camera, for example. That is a computer. Your home router. I have heard of cases where home routers, your Wi-Fi router from home, were turned into email servers by hackers and used for sending out spam. So end users are quite important. And it's important to note that some types of cyber attacks don't necessarily use technical means. And I have listed a couple of examples here. One would be where people just using normal emails tricked Facebook and Google into paying them several tens of millions of dollars fraudulently, simply by impersonating legitimate entities through email. So that's one case where the human factor worked greatly to the disadvantage of the companies that were affected. Had it been that these emails had been identified by a human as being fraudulent, then maybe this might not have happened. And on a more positive note, there are examples of cases where the human factor has been the saving grace of the entity, where the loss could have been way more severe had a player or a role player in that event had they not been as vigilant as they actually were. So a few years ago, there was an electronic heist where I think something like $80 million or something was stolen from the Bangladesh Central Bank. That 80 million could have been $1 billion if it weren't for a typo that was identified by a person involved in the processing of that transaction. So humans are quite important to maintaining your cybersecurity.
Phillip, just quickly.
Yeah.
Managing cybersecurity sounds costly and time-consuming. How do we go about staying secure with limited resources? Is it something that a small business should look at?
That's a great question, and it's especially relevant to small businesses. So like you mentioned earlier, planning is very, very important. And going back to your original question of what to do in the event of a cyber attack, in many cases, your options will be limited to basically how the figurative pieces on your chessboard were laid out at the time of the cyber attack. So in the case of ransomware, for example, if you didn't maintain backups, then you can't resort to backup as a means to responding to that cyber attack. If you didn't have insurance that deals with that kind of eventuality, then you don't have any means of recovering that financial loss. There are a few examples follow the same line where how you planned for that eventuality limits what options you have when that eventuality strikes. So planning is very important. However, the problem with planning, or rather I should call it the challenge with planning, is following through with the plans can be a bit tricky, and depending on how you do it, it can result in a set of actions that are maybe out of step with how you actually operate as a business. So planning is important, but it is important how you carry out that planning. So for small businesses, they might find relying on planning alone to be a bit of a challenge for the reasons I've mentioned. But I do suggest that to supplement planning as a control, I would recommend that you just follow business practices and technology practices that have some kind of inherent protection against certain types of risks. So one big one would be, for example, the choice between cloud-based applications versus on-premises applications. So the moment you have a server in a self-hosted data center, even if it's in the server room, you're responsible for managing the physical risk associated with that server. So if there's flooding or a lightning strike in the building or whatever the case may be, it's your job to monitor that risk and respond to it as it arises. Whereas if you host your applications with a cloud-based provider, say AWS or Azure or something like that, then dealing with physical risk becomes their problem. So you don't really eliminate that problem altogether, but it does kind of like shift that set of problems to a specialist that does this at scale and might be better positioned to manage that kind of risk than you are. Same goes for the choice between local applications versus web-hosted applications. So if you're running an application on your computer, then the role of things like antivirus becomes way more important than if that application is being run in the environment of a SaaS provider. So there, they can worry about protecting the system and protecting the data. And your biggest concern would be to just make sure your login credentials never get compromised. So the amount of admin you have to do is quite limited. And we did experience this last year when COVID struck, and all of a sudden everyone had to figure out how to start with the remote working. So as an audit firm, the bulk of our employees are out at clients carrying out work on site. So they are in effect carrying out work remotely. So even before COVID, instead of working from home, they might have been sitting at a client's offices, but it is remote work, such that when COVID actually struck and we had to figure out how to work remotely, there was barely anything that had to be done with respect to the client-facing employees. And we had a little bit more work to do in terms of the admin stuff that were generally based at the office, but even then it was quite minimal. So all our applications are hosted in the cloud already. We were used to coordinating over large distances and so on. So that kind of created a built-in control against the risk of widespread a lack of access to workspaces that was caused by COVID. So always plan, and beyond planning, just try to follow practices that create a kind of inherent protection. The last one, yeah, maybe that's worth mentioning there would be, so if you're in an organization that has an internal audit function, then if you have a culture of using data analytics, for example, then that would help you as well in protecting against the risk against integrity, even if it's not something that you're targeting head on. But the mere fact that you have software in place that does continuous monitoring for you would protect or would put you in a better position to flag the problems with your data that might be missed in an environment where you don't carry out that work.
What's the standard way of dealing with all the issues you've raised?
All right, so unfortunately, there is no template that would fit every context. So there is no one size fits all solution. And this is for a number of reasons. Our data security practices at Kreston would not cover all of the risks that a manufacturing concern has to worry about. And they wouldn't face the same risks that a software provider might worry about, where they're actually building software and have to think of security literally from the first line of code all the way up until their distribution process to their customers and so on. So it's always going to be a context dependent. And for that reason, it is necessary that you do consciously plan and think about these things, because there's always going to be that one risk that other people don't have to think about that is an issue in your environment, and vice versa. So it's also worth noting that you can't really eliminate all the risks associated with data security. Kind of like what you alluded to earlier on, from a general risk management point of view. Some risks are systemic and can't be dealt with by the individual. So it's worth being mindful of that. And some risks are also improbable or less probable than others, and might require a different level of robustness in response to more serious risks. So yeah, context is important. And the one thing to look out for is trade-offs. There is no such thing as an hackable system, for example, simply because if there were, then it would probably create such major inconveniences in other areas of your business that would make it impossible for you to carry out your work. It's quite common to see tension between convenience and security. So you might have, I don't know, like two-factor authentication on your systems that you can only access from specific locations and. So when you layer all of those models, when you layer all of those measures, beyond a certain point, it might actually make your systems unusable. So you kind of have to give way for that. And likewise, some measures will cost more than others. You might want a state-of-the-art threat detection system, but maybe that's more appropriate for a bank where the risk and the amount of resources that they're protecting are warranted. Whereas if you're a service business, generally, then it might not make sense to spend that much on certain types of systems. Your technology choices would affect what your options are from a security point of view. That's just another source of trade-offs. And yeah, lastly, the other thing to look out for is the role of service providers. So I quite like the idea of SaaS products or software as a service products and cloud technologies. But then it does create a new risk that never really existed before, as in you might have data that needs protecting that your IT department doesn't really know even exists, for example, because the way you accessed it was through the way you access the system is as a subscriber, to a subscription, a subscription-based business that is accessed through self-service and doesn't have any direct IT or hardware implications in your internal environment. So in farming out some of these risks to your service providers to manage, you are creating a bit of a vulnerability there. So yes, it's great in some respects from a security point of view, but it can be a problem also. And one good example of this would be, I think it was maybe 10 days ago or something like that, where Facebook had an outage and all of the services were inaccessible, everything from Instagram to Facebook to WhatsApp and so on, which sounds trivial, but then imagine you are a business that uses Facebook for authenticating your users. Then it means that throughout the duration of that outage, users couldn't log onto your website. So there are risks to using service providers and benefits as well. And all of those just need to be weighed up. And for that reason, every company will have to sit down and constantly work out what is most applicable to them.
Thank you, Phillip. We're going to hand over now to Johan Heydenrych to look at the tax implications of such events. Johan is a director at tax services at Kreston, Pretoria, and also a well-known presenter. So Johan, as we know, all events, even these events of business disruption, has a tax implication. In the limited time available, what are the most important tax risks that you wish to highlight today?
Yeah, thank you, Jacques, and thank you for the opportunity. Today, I would like to talk about three things. The one is that if you receive insurance claims, what are the VAT and the income tax consequences? And then I'll have a quick discussion on the rollover relief for involuntary disposals, and then I'll have a few commentaries on business rescue. So I'll talk about 15 to 20 minutes, and so I won't be able to go into too much depth in any of these subjects, but let's try and highlight some of the most important aspects thereof. So firstly, the tax implications of insurance claims. The most important one is the Value Added Tax Act. So this is governed by Section 8.8 of the VAT Act, which says that if a vendor receives an indemnity payment, so this means you do not have an output VAT liability when an asset is replaced. So if the insurance company gives you another assets, they give you another machine, then you don't have an output tax liability. But if they give you cash, then you've got an output tax liability. So if you receive an indemnity payment, then you have to pay output tax. Or, and I'll do an example of that, is indemnified under a contract of insurance by the payment of an amount to another person. So even if there's a payment to another person, if you're indemnified by that, then you will have the output tax liability to this. And then it applies to the extent that it relates to loss incurred in the course of carrying on of an enterprise. So, for example, during the recent unrest, many bank branches were destroyed. So if that bank branch were to receive an insurance indemnity payments, the banks applies apportionment formula. So if they receive the cash payout from Sasriel, they will have an output VAT liability only to the extent that they have made taxable supplies out of that bank. So 60%, 40%, whatever the ratio would be. So that will be deemed to be a consideration of services rendered. So if you are a farmer and your fruit gets destroyed, even though it's fruit, you are not deemed to have made a supply of fruit, which will be zero rated. You are deemed to have made a supply of services. So you'll pay output tax on it. Many farmers get this wrong. They think the crops have been destroyed, or a truck with apples have been destroyed. And then they think they don't have to pay output tax because it's apples. But you are not deemed to supply apples. You are deemed to supply a service. And it's on the date that you receive the payment. So the timing is linked to the payment that you receive. All right. So it doesn't apply if the underlying contract itself didn't carry VAT, for example, life insurance. And it also doesn't apply that if it's, for example, a car on which you couldn't claim the input tax, or a canteen or anything, and you get a payment of money for the total reinstatement of the car, then you also do not have an output tax liability. The definition of insurance is quite wide. So it's not just insurance with an insurer. So there could even be a contract of insurance between parties. If I provide you a guarantee, then that could also be a contract of insurance. So let me go to a number of examples that will just illustrate this. So let's assume a vendor buys a single cab bakkie. He pays 345,000 Rand for it, and he claims 45,000 Rand for input tax. So each cost is 300,000 Rand. The bakkie, you must always insure VAT inclusive. So you insure it for 345,000 Rand. The next day, the bakkie gets destroyed. The insurance company will pay you out 345,000 Rand. So what's the logic to this? Your outflow was only 300,000 Rand because SARS paid for the 45,000 Rand. Then you get 345,000 Rand and you go and buy another bakkie. So then you claim 45,000 Rand again as input tax deduction. So as you can see, if it wasn't for Section 8.8, you would have claimed 90,000 Rand as input tax, but obviously, so SARS would have paid 90,000 Rand, but you did not recoup the original one. So Section 8.8 is there to recoup that original one so that there's equilibrium. As you can see, you would have claimed the 45,000 Rand on the purchase of the bakkie. Then when it got destroyed and you get the insurance payout, you pay 45,000 Rand out again, and then you get a 45,000 Rand deduction being replaced again. It's important under Section 16.3c, the insurance company can claim a VAT deduction for whatever they pay out in terms of that. So that's a notional input tax deduction for the insurance company. This illustrates how this works to the extent. You only pay VAT to the extent. So let's assume you have a building. 60% of the building is used for residential purpose, so you do not pay any VAT on it. 40% is rented out for commercial purposes, so you do pay VAT on it. So 40% of the rent that you receive, you pay VAT. 60% you do not pay VAT. Gets destroyed, you receive 11.5 million Rand. Your output VAT liability is 1.5 million times 40%, because that's the extent to which you used it to make taxable supplies. Okay. The insurer can still claim the full 1.5 million Rand as an input tax deduction. But remember also, the insured, the landlord, you could only claim 40% of the VAT back on each insurance payment that you have. All right. So the third example, let's assume Ted owns the land and there's plantation farming on the land. He has comprehensive insurance with Santam. All right. Let's assume there's a fire and the fire causes damage. Santam pays out 1.150 million Rand to Ted. So obviously, his farm is in the production of income. If he sold the plantation or the timber, he would have paid output VAT on it. So when he receives the 1.15 million Rand from Santam, then he must pay 150,000 Rand to SARS. Santam claims the input tax back. Straightforward. But let's make the facts a bit more complicated. So Ted's neighbor, Susan, she also suffers damages because of this fire, which was caused by the negligence of Ted's employees. So Susan says, but I've now suffered a damage of 2 million Rand. So what are the VAT implications now? That 2 million Rand is now excluding VAT. And this is the interesting concept. What happens is that Ted is indemnified by the payment by an indemnity payment made to Susan. So the output tax liability in terms of Section 8.8 rests on Ted. It does not rest on Susan. Susan received this money. She didn't make any supply. She's not indemnified by a contract of insurance. She's just the recipient of that money. So what happens in this case is that Susan receives the money, but she receives it tax-free. She doesn't have to pay any output tax on it. Ted is indemnified by contract insurance. He must pay the output tax on this. So be very careful with these kind of things where there are payments made to third parties. And the insurance company must be careful for that because they must pay the VAT amount to the insured, and they must pay the net amount to the person who suffered the damages. Okay, so be very, very careful in this kind of scenario where third-party payments may actually give rise to a tax liability in the hands of the insured. All right. What about income tax? Now, everybody thinks about what is the time of accrual, or what is the time for accrual of this insurance payment? And that's the wrong way to look at it, because Section 23C tells you that you can't claim a tax deduction in respect of any loss or expense which is recoverable under a contract of insurance. So if you have stock and you purchase stock, but now the stock was burned down in a riot, okay, and you submit the insurance claim. And the insurance claim only pays out next year. You can't get a tax deduction for that stock, even though it's destroyed, even though it's not at year end, because you are going to recover it. When the insurance payment comes out, the insurance payment is actually not taxable because it fills the hole of something that was not tax deductible. So when you're looking from this perspective, it's not about whether the insurance payment is taxable or not. It's whether the expense which is insured is deductible. And that's the way you should be looking at it. Obviously, if you have a loss of profit insurance, which means that your expenses was 100, or you had a contract and there's a loss of profit insurance, and your expenses was 100, but you are insured for the loss of profits of maybe 20. That 20 insurance that you get is then about the time of accrual, and that's generally when you agree with the insurance company that and the loss adjuster has then finally said, this is the amount that I'm going to pay out to you. All right, so that is insurance. Rollover relief, it's very, very complicated. If you do elect to do that, it's an election. So, and it only applies in terms of involuntary disposals. So I've highlighted certain extracts from the capital gains tax guide, where it says that it enables you to defer a capital gain when any asset has been destroyed by theft or destruction. But the insurance must be more, or at least equal, to the base cost of the asset. So if you run a loss, you don't have that, you don't have the rollover relief. Must be more, and you must invest in replacement asset. Read through these extracts, but please note there are numerous requirements. You must contract for the replacement asset. You must actually bring the replacement asset within 3 years into use, the values, and becomes even more complex because if you have one asset and your replacement assets are numerous assets, then you need to be able to spread the recoupment and the like. So when you do elect to have that, if your fixed property have been destroyed, you receive insurance payout, you don't have to pay that capital gains tax now if you're going to replace the asset. You can then have rollover relief for that. So be aware of it. And if you do want to make use of it, then seek professional advice. So that's a rollover relief. When you're going to business rescue, what is business rescue? Business rescue is really governed by Chapter 6 of the Companies Act. So it's a Companies Act concept. And it's all about trying to get a financially distressed company back on the road again. And by doing that, they appoint a business rescue practitioner, a BRP, and that business rescue practitioner must prepare a business rescue plan. All right. So that business rescue plan is there to to try to rescue the company, but they are trying to work for the benefit of affected persons. So the affected persons are employees, it's creditors, it's financiers, and the like. Now, it only kicks in when there's financial distress. Financial distress is generally two things. It's when you've got liquidity problems or you've got solvency problems. So liquidity problems is you are not able to pay your debts as they run. You're not able to pay your bills within the immediately ensuing 6 months. Solvency issues is when your liabilities exceed your assets. And then a business rescue plan must be aimed to restore liquidity and restore solvency. All right. So this is just what must be in the business rescue plan. It must contain the background, it must contain certain proposals, and it must work on certain assumptions. But we are here to talk about tax. Now, the main thing that I see under business rescue plans is people are underestimating the risk, the existing risk regarding SARS. Because the company doesn't go into business rescue because everything is going well. It is because they were struggling. They were not able to pay the creditors. So shortcuts took place. And then you think, dang, they've got a big assessed loss. I don't have to worry about any taxes. You don't think about POI. You don't think about VAT. You don't think about a number of things. So the first step, as you go and look at business rescue, is there any unrecorded liabilities with regard to SARS? All right. So apart from just checking what the liabilities is, there are certain things that may give rise to VAT liabilities. Creditors have not been paid. If creditors have not been paid in 12 months, then there's an output VAT liability. There's a clawback liability in terms of Section 22(3). Additional interest-bearing loans have been injected to the company. If it's a connected person, transfer pricing, you may have a transfer pricing problem. Group loans have been subordinated. If it's subordinated, and the auditors have not specified that it's because of the going concern principle, it may be hybrid debt instrument, and the interest may now be deemed to be a dividend, and you've got to be careful about that. Penalties may have been incurred because there were breach of contracts. What are the tax treatments of those penalties? There may be employee fraud that may be prevalent, which caused you to run into problems, things like SAA and the like. And then tax payments may not be made. POI was deducted, was never paid over, VAT was never paid over, there's inconsistencies. So your financial records may not necessarily be a true reflection of what your true liabilities is. The business rescue practitioner can look at the recovery from taxes from individuals, and the Tax Administration Act can actually recover taxes unpaid from people who are controls or regularly involved in the management of the overall financial affairs of a taxpayer, and they negligently or fraudulently don't pay any tax. So be careful, Section 180, because as a company is becoming into financial distress, they may be taking certain shortcuts. All right. So if you're in yes, John?
Sorry to interrupt. So what are the options available for taxpayer when it's simply unable to settle its tax liabilities due to financial distress?
Now, Jacques, fortunately, the Tax Administration Act allows you to negotiate with SARS. The best that you can do is play open cards with SARS. And generally, the business rescue practitioner must have, his first stop must go to SARS and say, listen, this is what I'm dealing with. You can ask for a deferral arrangement. So in terms of Section 167 and 168 of the Tax Administration Act, you can ask SARS for the deferral of the tax payment. And that is generally granted if you're suffering from liquidity problems and you can't pay your taxes now. But over time, you believe you would be able to pay your tax. So you can say to SARS, I know I owe the VAT, I know I owe the income tax. Here's an acknowledgement. I'll pay it off over 12 months. I'll pay it over 24 months. So it's a payment plan. It's a payment plan. And this is a very powerful tool, especially in the COVID-19. But play open cards, go speak to SARS and say, can't we enter into a deferral arrangement that I can pay it off? If it's really bad, you can go into compromise with tax debt with SARS, where you can agree with SARS, and this is final, that you will only pay a portion of the tax. So SARS will really look at it and say, okay, you are bankrupt. The assets clearly do not exceed the liabilities, and let's take what we can take, and we'll also take 20 cents in the rand, whatever. So in that case, you will have to go into a formal compromise agreement in terms of Section 200 and 204 of the Tax Admin Act. The requirements are listed there, and you apply formally for this. So SARS are not very keen to do it. it takes a lot of price. They'll first try to have a deferral arrangement, but if that doesn't work, it's better to just compromise. And then especially after that, if you want to liquidate or deregister the company. Remember, you can't deregister the company if there's still any creditors left. So a compromise with SARS will be one of those things that you can do before you do register. Otherwise, you've got to go into liquidation. So that is actually seeing, that's everything that happens before you would have even start with the business rescue plan. But the business rescue plan itself may have tax consequences. And for me, that's quite a concern, because many business rescue practitioners are not thinking about the tax consequences of the actual plan. So the actual plan generally deals with restoring liquidity and deals with restoring solvability. So these are kind of the things that can happen. There are certain things that they can do which will create both liquidity as well as solvency to raise more equity. Okay, normally that is fine. There's no securities transfer tax on the raise of new equity. You can issue more preference shares, but if you issue more preference shares, just be careful that you don't have a Section 8E problem. And you also need to check your IFRS disclosures if the company is subject to full IFRS. You can raise finance with third-party backed shares. Be careful for that, because then Section 8E will deem the income in the hands of the holder still taxable, but in the hands of the payer still be dividends. So be careful for things like third-party backed shares. You can improve solvency without improving liquidity. So you just convert debt in equity. It's not really doing anything to cash, but it's just strengthening your balance sheet, and it may give you the opportunity to raise more external finance. So shareholders loan, just convert it, but be very careful of Section 19 and paragraph 12A of the 8th schedule, because effectively you're compromising your debt. You're taking a loan that's got a face value of $1 million, you're converting it into a share that's got a market value of 0. So effectively, there's a compromise. You've got to look through Section 19, you've got to look through paragraph 12A, because there could be certain recoupments and things, but there are exclusions as well. So that is a whole course on its own. You can waive debt. That quite clearly will give you in Section 19 problems, paragraph 12A problems. Again, certain recoupments may come into play, certain capital gains tax events. And I've often seen it that the business rescue practitioner will go to the creditors and say, just waive your debts, please. Then we've got a income tax problem, as well as we have a VAT problem. Because if I've claimed the VAT on R1 million of a creditor payment, and he waives 800,000 Rand of it, I'm only paying him 200,000 Rand, I've got an output VAT liability on 800,000 Rand. So I've often seen many of these business rescue plans coming out, and they don't think about the VAT liability. They don't think about the fact that you're going to eat up your assessed loss. I've even seen situations where the liquidity problem is so big that they want to compromise debts of 20 million, but the assessed loss is only 11 million. That will kick them into a tax-paying position of 9 million, and they didn't plan for the tax payment on that 9 million. You can raise finance with subordinated hybrid debt instruments. Be very careful again that interest is not regarded to be dividends. You can raise finance from group companies. Be careful when the group company is not paying tax, then you may have the interest deductibility problem in terms of Section 23M. For example, if your holding company is a PBO or it's a non-resident. You can sell non-core assets. The sale of assets will attract capital gains tax, it will attract VAT and other indirect taxes. All right. Then you can, so these are immediate steps that the business rescue practitioner can do. They raise finance, they sell assets, excess assets, and all those kind of things. But then they can also look at just the ongoing activities. Ongoing activities, there may be an on-risk contract. There may be a supply agreement where you're overpaying a creditor. You may have a lease agreement for a building that you just need to get out as excess space. Be careful when you pay amounts to get out of on-risk contracts, because the tax consequences of this, it may be capital, there may be VAT, you don't know whether you can claim the VAT on it. To get out of certain on-risk contracts with employees, Ford in the US got itself into problems with post-retirement medical aid. So all of these things to get out of it cost money, and it will have tax and PAYE implications. If you retrench excess employees, look at the tax consequences. If you're just retrenching some employees, it will be tax deductible. If you're retrenching everybody, there's a concern that it's not in the production of income. Personally, I don't ascribe to that view, but there is certain tax technical issues that you have to consider. And then you can sell a business as going concern. Again, there, look at the tax deductible of contingent liabilities. Interpretation note 94 is very relevant, because if you don't look at it carefully, then things like provision for leave pay and bonuses and all of these things will not be deductible for the seller or for the purchaser, or motor plans or warranties or any of these contingent liabilities. You've got to plan that very, very carefully. All right. So careful risks, I mean, when you're selling part of the business as going concern. All right. You can improve operational efficiencies by reducing stock holding, limit discretionary spend. All of those will have tax consequences, which you need to consider, tax efficiencies, VAT efficiencies as well. So lastly, this is not really to do with the Income Tax Act or the Value Added Tax Act, but it is, as you are progressing through your business rescue plan, think very carefully about things like the Consumer Protection Act. So for example, there are numerous airlines that went into business rescue, and some of them honored their flight tickets because they had to. Because in terms of the Consumer Protection Act, if I pay for my flight now, and the flight is only after 25 days, that money is still deemed to be mine. It's not deemed to be the money of the recipient. So as you're going through the business rescue practitioner plan, and see whether that company has complied with the Consumer Protection Act. Because if they've taken that money for themselves, then they've contravened the Consumer Protection Act. And in terms of Section 65 of the Consumer Protection Act, you have to protect that money, keep that money separate as if it's not yours. So many culprits in this are your airlines, it's the accommodation, it is gyms, because the gym's the same thing. You pay for your gym membership for 12 months in advance, but that money remains the money of the consumer, and only monthly can the gym actually take hold of that money.
Thank you, Johan. I think we're a bit pressed for time, but it's been very insightful. You had to rush through your presentation, but thanks a lot for that. I want to thank all the panelists for attending and for their inputs. It was very insightful. Disruptions are unfortunately a fact of life. It's going to happen, and it's going to happen again. It's the way that we plan for it, and it's the way that we react while the event recurs, and then how we implement steps to make sure that we learn from those steps. Please keep accounting, reporting, and taxation in mind. Thanks to everyone attending this, and we appreciate your contributions. We will try to answer all your questions that you've posted. So just be patient, but we'll come to your question. Thank you, everyone.